Hello, everyone. I'm TJ Silliman.
I'm
This
Daniel
is
Minks.
Daniel Minks. Um, Today, we will be discussing the role of central banks in managing inflation. Some of the stuff we'll talk about is the tools they use, the challenges they might face, and the impact that they have. This topic is crucial for understanding how economies remain stable and how central banks maintain balance through inflation management. Inflation affects everyone, whether it's a rising grocery prices or the interest on loans, and central banks play a critical role in managing these effects. Over the next 15 minutes, we'll explore what inflation is, the tools central banks use to control it, the challenges they face, and how these policies impact different stakeholders. Let's dive in.
So this is the central banks and inflation. You guys being in this class know exactly what probably both of these are, but it doesn't hurt to go over it again. So let's kind of start with the basics of what is inflation. Inflation refers to a sustained increase in prices for goods and services over time. This reduces the purchasing power of money. What you can buy with $1 today might cost $2 tomorrow. Obviously, it's probably not that extreme right away, but you get the gist. Inflation isn't always bad either. Some people really don't think so. Some people think it's horrible, but it really isn't that bad because mild inflation is a sign of a growing economy and it also encourages spending. However, if it's high or extreme inflation, that can harm an economy in a couple of ways. That being, it can erode savings, making money less valuable. It can raise the cost of living, hitting these low-income households hardest because these people don't even have enough money to afford as it is, and it's just making it harder on them. And then it also creates uncertainty for these businesses because this is then discouraging their investment in things and then their overall growth in general. So where do these central banks fit in? Central banks like the Federal Reserve or the European Central Bank are responsible for maintaining price stability, promoting economic growth, and also fostering employment. Think of them as so-called stewards of the economy, using monetary policy to prevent inflation from spiraling out of control while supporting sustainable growth.
The next slide is key monetary policy tools. Central banks use a range of tools to manage inflation. These can be divided into traditional and unconventional tools. The next slides that we'll be talking about are adjusting interest rates, open market operations, reserve requirements, and quantitative easing. Each of these tools impacts the money supply and borrowing costs differently, giving central banks the flexibility to respond to changing economic conditions. To better understand their importance, we'll look at each tool in more detail.
So the first one we're going to talk about is the interest rate adjustments. Interest rate adjustments are the most widely recognized tool for controlling inflation. Basically, it's the most common one we use. Central banks set a benchmark interest rate, such as the federal funds rate in the US, which influences borrowing costs throughout the economy. While inflation is high, central banks raise interest rates. So this influences borrowing costs throughout the economy. These higher rates, while borrowing becomes more expensive, it also reduces customer spending and business investments. This slows down the economy, cooling inflation. On the other hand, when an economy needs a boost, they lower their interest rates to make borrowing cheaper, encouraging spending and growth. So for example, after the COVID-19 pandemic, on this next slide we'll talk about, central banks worldwide reduced rates to a near zero level to support economic recovery. However, as inflation surged due to the supply chain issues and increased demand, the Federal Reserve rates in 2022, they raised rates to curb inflation. While effective, this tool comes with risks like potentially triggering a recession if these rates are raised too high. So this slide right here is your real life example. Basically, they wanted to stimulate the economy in this recession. So the impact it had was borrowing became cheaper for business and consumers, the stock market surged, and then going right back to it, as inflation had spiked post-pandemic, it then led to rate hikes in 2022 to help control and manage inflation.
Next slide is open market operations. What is it? Open market operations are the central banks that buy or sell government securities to manage the money supply and interest rates. When central banks buy securities, they inject money into the banking system, lowering interest rates and encouraging borrowing and spending. When they sell securities, they pull money out of the system, raising rates and slowing inflation. Both buying and selling securities are how it works. A great example of this was during the Great Recession of 2008. The Federal Reserve bought large quantities of securities to stabilize the financial system and restore confidence in the markets. This not only reduced interest rates, but also helped businesses and consumers weather the crisis. Open market operations are a powerful and flexible way for central banks to fine-tune economic stability.
Yeah, so this is just a slide talking about that. The U.S. Federal Reserve in the 2008 crisis, they bought large-scale purchases of treasury bonds and mortgage-backed securities. This was just to give the banking system more liquidity and also stabilize the financial markets. This resulted in an increased money supply with lower interest rates, adding a little bit more recovery for those markets. So the next thing is the reserve requirements and also the quantitative easing. So reserve requirements dictate how much money banks must hold in their reserve and not lend out, or it's like the percentage of deposits that they have to hold in their reserves. By lowering these requirements, central banks can increase the money supply, boosting lending, spending, and also inflation. And then quantitative easing, or QE, as you'll probably see it later. This is a newer, more unconventional tool used during severe economic downturns. Central banks buy long-term securities, which injects money directly into the economy. This was a key strategy during the 2008 financial crisis and the COVID-19 pandemic as well. While quantitative easing provides a quick boost, it can lead to asset bubbles and long-term inflation if overused. So for example, QE helped stabilize financial markets during the pandemic, but also contributed to inflationary pressures as the economy recovered. This next slide will point out another real-life example of the QE used by Federal Reserves from 2008 all the way to 2014 during their global financial crisis. They purchased $4.5 trillion in treasury bonds and mortgage-backed securities. They did this over 3 different times. They did the first one in 2008, second one in 2010, and the third one then in 2012. They kept it spread out so they didn't impact it too fast, too quick, and have something go wrong. While they spread it out, it made it easier to control. This lowered interest rates, boosted the housing market and stock prices, but it also came with some criticism because there was some wealth inequality concerns between people who are making more and people who aren't. So businesses, people, whoever. So target inflation, and they also helped guide people. So inflation targeting is a communication strategy central banks use to set expectations. Most central banks aim for a target of about 2%. This number balances the need for economic growth with price stability as well. By clearly stating this goal, central banks help anchor inflation expectations. For instance, businesses and consumers can make better financial decisions knowing inflation is expected to remain stable and they don't have to worry about it as much. But they can also give forward guidance to these people because this goes a little bit further. Central banks share their future policy plans, signaling to markets how they might adjust interest rates or other tools. For example, during the pandemic, central banks provided clear guidance about keeping rates low for an extended period. This transparency bubble, it builds trust and it reduces uncertainty in the financial markets, so people are more prepared.
Challenges in managing inflation. Despite these tools, managing inflation is a complex task with significant challenges. The first one would be global supply chain disruptions or world events. Events like the COVID-19 pandemic, world political tensions, natural disasters create shortages and drive up prices, making inflation harder to control. The next one would be stagflation. This occurs when inflation remains high while economic growth slows. It's a rare but difficult scenario seen in the 1970s, requiring careful policy balancing. The next one is inflation expectations. If businesses and consumers believe inflation will rise, it can create a self-fulfilling cycle of higher wages and prices. And the last one is political pressure. Central banks are independent, but they often face pressure from governments, especially when raising rates slows economic growth. And now the next slide is impact on stakeholders. The first one, the central bank's actions don't exist in a so-called vacuum. They directly impact various groups. The first one is consumers. Inflation erodes purchasing power, especially for those on fixed incomes. Controlling inflation helps protect their savings. This is high inflation transitioning into low purchasing power. Next one is investors and businesses. Higher interest rates increase borrowing costs, which can reduce expansion and hiring. This is high rates leading to lower investments and higher borrowing costs. Global economy, central bank policies in major economies ripple across the world, influencing exchange rates and investment in emerging markets. Actions in big countries can reflect and impact other countries through capital flow and exchange rates.
All right, so this slide is just two case studies that we looked at that we think are pretty interesting. We talked about the COVID-19 pandemic response, and we mentioned earlier about the 1970s. This is Paul Volcker and their inflation crisis. These just give a quick summary. If you guys want to look for it deeper, I put a link in this slide. So if you guys want to go to our presentation, look it up, I would suggest it. It's really cool thing to look at. I'll give you a little bit of summary before we do. We talked about the COVID-19 thing, but basically central banks worldwide slashed the rates and implemented quantitative easing to support economies during the pandemic. However, this had resulted the resulting inflation forced them to reverse the course and then eventually raise rates in 2022 to balance it out. The second one is Paul Volcker's fight against the inflation in the 1980s. The U.S. had faced runaway inflation in the late 1970s. So then Volcker, who was at that point a Fed chair, raised rates sharply, causing a recession, but that successfully brought inflation under control. So this was pretty risky, but it actually worked out really well for him, and it was a great idea in the long run.
Lastly is our Christian reflection. The two big points that I wanted to mention was stewardship and justice. Stewardship, we are called to be responsible stewards of creation. This extends to economic systems. Central banks act as stewards, ensuring resources like money retain their value for everyone. Managing money supply aligns with biblical calls for wise resource use. The next one is justice. This stable prices and fair access support the vulnerable. We need to be reminded that fairness is crucial. Managing inflation protects the fairness of prices and wages, particularly for the poor and vulnerable.
Yeah, and then these last two are ones that I really liked. The first one being integrity. We talked earlier about the trusting our financial systems. Having them be transparent with us on what they're doing really helps build that trust, because if we don't trust that they're not going to do the right things for us, then that's really tough on us. And if we can help them in any way, that's a good thing, and that builds trust between us. The second thing is the challenge. This one's talked about since you were probably little kids. It's all about greed. We're dealing with a lot of money in that scenario. So, policies and governments, they must avoid the greed, and they also need to address equality. So rich, poor, they need to be treated equally, or find a way to find a balance between that. So that's basically all we have for you guys. Basically, in conclusion, central banks play a vital role in maintaining economic stability by managing inflation. So while their tools are effective, challenges like supply chain disruptions or political pressures make their task a little bit more complex. Ultimately, the goal is to create this fair and stable economy that benefits everyone. In a sense, if you do all these things that we had talked about in the Christian Reflection too, principles, everybody will be able to see that these biblical principles, when done ethically and responsibly, are a great thing. So that's all we got for you guys. So thank you. If you have any questions, let us know. And thank you.
Oh.